Welcome back to another Random Gleanings. Chris, I'm Jesse, and today, Chris, we're talking about we've just recently hit a new all-time high.
Yep.
Is that a good thing? Is that a bad thing? What should people be thinking as we have once again climbed that wall and the mountain chart continues higher?
I mean, it's always a good thing. I mean, it's hard to argue that it's a bad thing. I will say that, the other thing is that a pretty big base has formed. I mean, one of our technical strategists loves to say the bigger the base, the higher the space. And I mean, if you look at this first chart and go back, I mean, there were 757 days that passed in between all-time highs, right? Like we hit 4,800 back in December of 21, and then went down to 3,700 and came all the way back and then hit 4,900. Well, it took over 2 years for that to occur, right? I mean, that's a pretty big base.
Yeah.
If you look historically going back, the biggest base goes back to May of 13. I mean, over 13 years passed between those
new milestones, right? Yeah. I mean, I think that is a noteworthy thing. I think another long period in there was some 644 days back in 16.
Yep.
And so again, I think, quite frankly, the recency of what people have lived through has been probably challenging based on the historics of this over the last 20 years. And so not anything to sniff at, but I think, and we're going to have some practical steps as to what you should do, having achieved all-time highs, or at least some of the things that you should be considering at the end of this episode. But, the question of, and I think that there's been some news out on the idea of, oh, well, this all-time high, is it an omen of things having to turn over? Using history as a guide, not as a predictor, this next chart shows that all-time highs actually kind of come in
bunches.
Chunks. Yeah, they come in bunches. And you can see 2022 had one. It was the very first trading day of the year in 2022. So for all practical purposes, 2022 and 2023 effectively had no all-time highs. We're now back there, and
we've had five.
There's nothing that just says that you have to see this thing turn over. And in fact, this next chart, again, hat tip to Charlie Bolello, shows that over the first year, on a 1 month, 3 month, 6 month, 9 month, kind of track record, buying at all-time highs has almost no difference than buying at any other time in market history.
I mean, there's maybe a tad, but not much. I mean, the only one that's higher on all-time highs is 9 months versus the other. I mean, but it's a pretty garden variety kind of outcome, right?
And that's the point.
I mean, on a 1 year basis, 10.5 versus 11.5. Like, I mean, are you going to sneeze at 10.5? Heck no.
No.
I mean, that's over double what cash is paying right now. So, I mean, that's pretty good.
So in a vacuum, I would suggest that, just because we've hit this new mile marker, it's not any reason to just expect that the market has to collapse again,
right?
Like it did in 22.
Yeah, but I mean, you could use this time if you're looking at all-time highs to, hey, rebuffer your cash position if you've kind of spent down what you've got in the bank or in your more.
And these are some of the practical steps I was talking about. I think that that's a critical thing to address with oneself is, having been through the storm of 2022 and using 2023 to get back, am I in the right risk tolerance? Am I in the right risk objective in my portfolio?
Yeah.
Do I have the right cash balance that's going to get me through the next storm?
Right.
Yeah, I think that those are absolutely practical things to consider.
So, and to be perfectly clear here, I mean, there are a whole lot more positive signals out there than there are negative. I mean, there's still some negatives. Yield curve still inverted. Mm-hmm. Show you a manufacturing chart here in a second. In fact, I'll show it to you right now. I mean, the manufacturing regional Fed manufacturing reports, Dallas, huge miss, Kansas City, miss, Richmond, miss, Philadelphia, miss, Empire, which is up in the Northeast, huger than huge miss. It's only the fourth time since 2012 that all five regional reports were negative and weaker than expected. Okay, does that mean recession? No, not necessarily. I mean, but it's not good. And in fact, that may be why you're starting to see some layoffs, right? I mean, and you are all of a sudden seeing more layoffs, a bit more negativity. I mean, this is only like 20% of the economy. Okay, the other 80% from a services standpoint, there's no question it's kicking.
Yeah,
It is,
no doubt.
So and further, if we take that a little further, look at what our technical strategist, one of our technical strategists, is saying. I mean, here's a chart of the Euro stocks 50, right? Like 85% of the top stocks have nothing to do with technology in this European index, right? New 20-year high.
Yeah.
I mean, that's positive. That's industrials. That's other things than just tech stocks, right?
Yeah.
Or small cap industrials, new all-time high. Same kind of deal.
Yeah.
So to the notion of, maybe the potential of things to think about, though. I mean, we are in an election year, which a lot of folks think is, it's going to be bad, right? Statistically, if you look at a 4-year period, it's the second best year going back to like World War II in terms of market returns. I mean, if you rank them, it's pre-election year, which is last year. Second is this year, election year. Third is the first year of a new presidency, and the fourth is the midterm year, which actually was 2022. So, they kind of line up. And as long as you're looking at averages, right, in terms of good times, bad times, I had my share. Sorry, little Led Zeppelin there. Tom Lee made a comment. Tom is kind of known. Next picture here. Tom is known as kind of a permabull, right? Always positive. I mean, he made a comment that it wouldn't be surprising to see a little bit of an air pocket.
Yeah, I think when someone that is known as that, even though he's rejected that title, but he has been very, very optimistic along the way. When he calls out attention to the risk, and his point there is after the parabolic rise from November till now,
right.
It wouldn't be unusual to see a little bit of a retracement. And I think you shared earlier in our conversation that February is one of those months that historically you see a little bit of a softening data sometimes.
Yeah, again, I mean, if you look at averages or you just take into account kind of statistical norms, going back to 1970 until now, the 3 months that are the toughest months for stocks are in this order: September, October, and then third is February. The total return, cumulative return for February, looking back over like the last 50 years, is like -4%, right? I mean, it's not big. It's not big by any means, but just a little bit more turbulent, right?
Yeah.
So, Tom Lee's kind of calling for this at a time period when it would be kind of normal to see a little bit of bumpiness anyway.
Yeah. And that's after he called back in the fall for an all-time high by the end of January, which has now occurred. So,
right.
Again, not to say he's got a crystal ball any better than us, but he's been a good analyst and so something to call attention to. You pulled this quote from Data Trek as well, which is a little bit more, I don't know, worrisome.
Somber.
Yes.
Yeah.
There you go.
I mean, the notion of so the Federal Reserve at the end of December said they project 3 interest rate cuts in 2024. Okay, fine. I mean, they've been higher for longer in terms of their dialogue. And I mean, I don't know what longer is, but it's still been pretty long that they've been kind of up in this range, right? Meanwhile, rates continue to pay, cash continues to pay 5+%, which is pretty awesome. Nothing's changed on that front at this point. But the market itself expects rate cuts somewhere in the neighborhood of 1.25% to 1.5% this year. That would be, 1.25% would be 5, 1.5 would be 6 quarter-point rate cuts. Data Trek and Nick Colas go on to say that has not happened outside of a recession since the 1980s. And, just in noticing, not a big deal. But, I mean, back then it caused investors to get a little too proud of themselves, and you actually had a pretty big market sell-off in Black Monday in 1987. It's not to say that that's going to happen this go around, but the bottom line is that the Fed does know all this. I mean, they're looking for roughly 3/4 point cut sometime this year, right? Could be the back half, could be measured, but
well, I think one noticing there on that CME chart is if you look at the blue squares, that's what's indicating where the probability lies for the expectation. And it was only last week that there was about a 90% chance of a first rate cut in March.
Right.
And then the GDP numbers came in very strong from Q4, such that it's now shifted back.
Right.
That they expect this rate to stay longer.
To where the first is expected to occur in May.
In May, that's right.
Yeah.
So,
but look, here's the reality of it. I mean, if business is still pretty good, then I mean you've got to think that they're more right than wrong. And in fact, again, the Fed has historically gotten this reputation for being absurdly wrong in terms of their projections. And yet the market seems to think it knows better at this point. Well, if it knows better, then there's probably a recession.
You don't see this level of cuts in a year without, outside of some other factor happening, and generally that is recession. So
a recession that's not showing up right now. Last chart here. This is a measure of all the major indices and how they're doing versus their moving averages, and on every time period, they're above their moving average.
Yeah.
So, I mean, it's really dang hard to get negative when you see that.
That's just it. Now, again, back to those practical things that one ought to consider given, maybe some of the underlying risks, but also, expecting more positivity from an optimistic view and a historical view is take this opportunity to readdress where you're at from a risk standpoint.
Yeah.
And if you need help in addressing that, we're obviously available to help you, guide you through that and ask the right questions, ideally to put you in the right position for the next few years.
Good stuff.
Yeah. Anything on your mind? Anything?
Still watching Jodie Foster and True Detective.
Okay.
Dude, it gets a little bit creepy. I mean, I felt some Silence of the Lambs type vibes. And
supernatural though, or
yeah, a little,
okay.
A little supernaturalist kind of, possessed. Ugh, it's a little freaky, freaky. So, but it's good. It makes me want to go back. But I've got the same feel. I remember having this feeling after season 1 of True Detective. It was like, I mean, we were out in California, Heath and I. Kind of watching the end of it, and I remember we're on vacation, and vacation's great and so much fun and everything, but it's like this little edge of sort of darkness there. And I kind of feel that in this too, which is weird, but it's kind of familiar too. It's odd, but it's really good.
Yeah, that's awesome. Well, I picked the 2 losers of the conference championship games. I wanted to see Detroit make their first Super Bowl, and a little tired of the Chiefs, and so was pulling for the Ravens. But now I've got a week off, and so hopefully I'll bring some fictional information or fictional shows to share next week. But,
sounds good.
Yeah. Well, thank you all for listening. Thank you for watching. And listen, hit like, hit subscribe, share this with a friend, pass it along. Encourage somebody else to take advantage of this all-time high, to right-size their balance sheet, to right-size their risk tolerance. And if they need help, we're happy to help. Thanks.